Hi, in this video, I'm back with you to talk about the markets, and as I indicated last week, using a newly added impetus chart which warned us in advance that the bulls were losing their strength, the market was slowing down in its momentum, and I'm going to pick up the thread where I left off last week, and we are going to analyze whether you have any cause for concern in the markets. Should you be worried, or is the market likely to go up after testing some more support? I'm Vijay Bhambwani. I'm a trader with 35 years of trading experience under my belt, 28 years of which are as a founder, promoter, and CEO of a limited company that trades for a living. I'm here to help you without any coercion of selling you something or offering any courses or webinars, etc., to help you become good traders, earn some money, and meet some pretty like-minded people and grow together. So let's dive right in. And last week, the markets turned cautious by falling 4 out of 5 trading sessions. The Nifty fell more than the Bank Nifty, and as the market roundup graphic on your screen tells you, that this index, being a broader based index comprising of 50 stocks, found it difficult to kind of pull itself up as compared to, relatively speaking, the Bank Nifty. So the impetus chart of last week had warned itself that the markets were likely to fall because the upward momentum had completely reversed, as I had showed you last week. And the expectations of a fall worked out perfectly well. As a matter of fact, the rally on the first day of the week, which is Monday, the 15th of February, was a misleading and a sucker rally. You see, the US and other Western markets were shut due to a holiday, and the markets on Monday shot up on extremely poor market internals, which is volumes, open interest, depth expansion, etc., which lulled the people into believing that the bull market was on. And as a matter of fact, I got some pretty interesting feedback and comments from some of the viewers saying that I was panicking them into selling stocks. Hey, all the best to you. And as the market roundup tells you, the US dollar fell marginally, which saved emerging markets, including India, from blushing under even higher selling pressure. And the other saving grace was falling oil prices. Remember, in my videos, in the past 20 videos, I have been telling you how you must take a well-rounded 360-degree worldview of the markets. Please ignore any kind of tunnel vision or looking only at equity markets just because you're trading only equity markets. All asset classes impact other asset classes, so you must take a look at commodities, bond markets, currencies. Everything that impacts your trade and can result in a loss must be factored into your calculations. So falling crude oil prices was another relief for the Indian markets, which would have fallen if the dollar was higher along with crude prices. So you need to watch the Dixie, which is the dollar index, and crude oil prices in the coming week. The bond prices, of course, continued to fall as the bond yield tells you on this chart. This gave grief to the Bank Nifty, which otherwise wouldn't have fallen as much. And I'm going to cover this in greater detail in the bond segment. Coming up on your screen is the MWPL chart, or the market-wide position limits. Now, it shows a week-on-week increase in absolute terms, but if you actually take a closer look, the MWPL actually fell on Friday. Now, the reason is not very far to see. The market had been falling for 4 trading sessions, so the bulls were losing their patience, and more importantly, there's an expiry coming up next week. So you have unwinding ahead of the expiry, which also results in positions being lightened up. Coming up on your screen is the basis chart, which shows you that the Bank Nifty basis, which is the premium of the future vis-a-vis the spot, it has shrunk considerably on a week-on-week basis, even as the Nifty 50 basis, which is the premium of the future versus the spot, fell relatively mildly. Now, this is due to a combination of selling pressure and the approaching expiry of the February series. Take a look at the volumes chart. Now, this is something that raises a red flag in my head. Now, the volume chart tells you that both the indices and stock futures, and mind you, these figures are across all expiries, which is February, March, and April. They showed a rising trend on a week-on-week basis. So while the markets fell, the volumes rose, which means the traders were participating in the decline, which means the market was not only not very surprised, but it was prepared and willing to participate in the selling. Now, this is a red flag. You must watch what kind of volumes are occurring on declining day vis-a-vis rising days in the coming week. Now for the impetus chart. Friends, there are many studies which are not available in Google or in textbooks or guides, which we have incorporated in our in-house statistical trading model, which we fondly call the Barracuda, which of course is neither for sale nor is it available to share. It's in-house. Like I said, our prop trading firm uses that for itself. Now, the impetus is something that Barracuda throws out at us. And last week, of course, the impetus chart was showing as if it was going to fall off a cliff. This week's chart is showing a relatively more sedate and milder decline. Remember, this is a leading indicator, which means this happens to be either ahead or with the market, as compared to many oscillators which are lagging indicators. They only turn after the market has declined significantly. So the impetus is actually a leading indicator, and it's telling us that as of now, the selling pressure has eased a little bit. Does it mean that the market will stop falling or fall less? No. A vicious bout of selling can still make the impetus chart go down rapidly ahead. It's just that the viciousness has probably decreased a little bit. That's all. Do keep your positions on your toes, trade light, and avoid very aggressive fresh long positions. So net summation of the market roundup is that the pressure still remains on the bulls. Now the roundup done, I'm coming to a significant aspect of the market which many people either don't understand, find boring, or whatever, they ignore it. But my friends, I believe in a 360-degree worldview of the financial markets, and my 3.5-decade experience tells me that anything that impacts the market deserves watching, and the bond prices deserve to be watched because it directly impacts trades on your banking stocks and the Bank Nifty. So here you're seeing the bond yields had risen to 6.15% in spite of the RBI attempting to push yields below the psychological round figure of 6%. The RBI will attempt another go at the bond markets on 25th of February using Operation Twist to the extent of 10,000 crores. I'm very keenly watching the outcome because the idea is to buy back bonds that are maturing in 2025, 2029 and 2033, and in its place issue bonds of a similar amount which are expiring in February 2022. The idea is to release the long-term blocked fund of the bank and make them block their funds only till February 2022. Alright, this is called Operation Twist. Now, is this going to succeed or will it flop like RBI's operation on 18th of February, which was a Thursday, wherein it tried to basically entice the primary dealers in the bond markets. But the bond market dealers refused to bite the bait because they found the interest rates being offered by the RBI to be fairly low. Now here is the fixed income investor resisting any more decline in interest rates. He's stopping to write checks because he is not interested in investing money at low interest rates, which means possibility of interest rates rising and therefore stock markets declining, especially the bank Nifty declining, is mildly elevated. This is not the be all and end all reason, but this is definitely a red flag. When interest rates are going to go up, the cost of money will go up. This is something that majority, I'm not being arrogant, I'm telling you with sheer experience. Remember, I have nothing to sell to you, no courses, no software, no nothing. So I speak as a neutral. Majority of the market is unfortunately unaware of this aspect of the market and they ignore bond yields. Now let nobody tell you that bonds are not important. So do remember that the government also has to raise 12 lakh crores in the next financial year starting from April, and therefore it is very, very interested in pushing bond prices, bond yields rather, lower so that it can reduce its own cost of funds. Now whether the bond markets will bite the bait, that remains to be seen, but as of now even the FIIs are selling Indian bonds. That's not really very good news. That's a red flag. Now the bond market done, let's come to the US dollar index, the Dixie as it is popularly known. Now this US currency versus the entire basket of currencies is treated as an index, which is called the US dollar index. It lost some grounds because the polar vortex and the vicious freezing climate in most parts of Northern America and Europe have inconvenienced business production, productivity, output, power, transport, etc. Therefore, the dollar index fell. It lost 0.13% on a week-on-week basis, and as long as it trades below 91.50, it will remain under pressure. See, as the chart shows, it's trading below its 25-day exponential moving average, and this index rose on 3 out of 5 trading sessions, but the declines were far more vicious as compared to the rallies. The round figure of 90 will be critical for near-term outlook of the dollar. If it trades sustainably below the 90 mark, the bulls will be at a significant disadvantage. Do remember that all emerging markets, including India, want a weak dollar because we are net importers, and a weak dollar curtails our imported inflation, allows us to repay our overseas debts cheaper, and it saves on interest on these dollar-denominated loans. Now, this is the reason why I tell you that you must watch the dollar, and let nobody tell you that you must stay focused and have blinkers on your eyes like a Gode ka chashma and watch only equities just because you're trading only equity markets. In the week gone by, I advocated a range between 91.60 and 89.40, which held perfectly well. The week coming up ahead is likely to see an estimated, I emphasize on the word estimated here, range between 91.45 on the upside and 89.25 on the downside. And this will have a bearing on all assets, crude, bullion and equities. So do keep watching the US dollar index. Friends, the dollar index done. Now let's go to the Bank Nifty. As you can see on your chart, the Bank Nifty fell on 4 out of 5 trading sessions, in the bargain losing 0.74% on a week-on-week basis. Bond yields had a lot to play in this, a big role to play in this decline. But the weak dollar rescued it from further falls. And the big gain on 15th of February, which is Monday, was actually a trap for the bulls because the international markets were shut and they fooled Indian traders into believing that the bull market was still on. And do note, in the last weekly market outlook, I had warned you that the bulls were appearing exhausted. This didn't really go down well with some viewers. And I got some pretty interesting feedback on my social media account. But hey, that's the truth out there and we can't really escape that. Now, the saving grace on the daily chart on your screen is that the index is above its 25-day exponential moving average and the blue dashed trend line, which are somewhat coinciding at the 34,600 vicinity. It is here that you might expect some semblance of support if the bulls manage to defend this threshold. All is well and the uptrend may continue. Remember, in the past, the market has given us some false alarms. It's threatened to decline, but then risen after a while. And this could be another one of those jitters that the market gets once in a while. But we would rather let the market tell us than second guess. Now, the previous week's high and low is a very critical area to watch out for. If the bulls manage to push the markets above the previous week's high, which is 37,700, all is well, the uptrend is back in force and you have nothing to worry. But the weekly low is 35,584 in the spot segment. If the bulls are unable to defend the Nifty, Bank Nifty rather, at this threshold and let it slide below it, I'm afraid fresh falls are likely. Now take a look at the weekly chart of the Bank Nifty. Note how there is a bearish inverted hammer which is formed on the chart, and here also the price is above its 25-week exponential moving average. But here the support is very steeply lower at near the 30,000 mark, which can be very painful for you to hold as a bull if you're nursing long positions, because your mark-to-market losses will be fairly significant. Now, after the big bullish candle 3 weeks ago, a little bit of a consolidation is but natural, even from the statistical mean reversion point of view. So I would suggest you avoid fresh aggressive buying, at least in the leverage space. Don't overextend yourself by trying to bottom fish or average your long positions in the futures. Last week I advocated a range between 37,950 to 34,275, which held perfectly well. In the coming week, I expect an estimated, I emphasize on the word estimated, range between 37,700 on the upside and 33,950 on the downside. In the week before last, this index was at number 4 on the most volatile list, and last week it jumped up one notch to number 3. Which means that the volatility is rising and you need to be extra careful and enforce your stop losses very diligently and basically tread on eggshells. Be very careful, and I'm going to tell you in the coming minutes as to what the Jensen's measure has to say about your market situation. Friends, with the Bank Nifty done, let's now proceed to the Nifty 50, the most liquid and the lowest impact cost counter on the NSE in the derivative space. Now, this index also fell 4 out of 5 trading sessions last week, and it underperformed the Bank Nifty by falling harder. Last week, the impetus chart gave us an advanced warning of a fall which came along expected lines. Do note on the daily chart how the negative divergence between the price and the RSI, which I have been pointing in my weekly videos, wherein the price was rising but the RSI was falling. This was again a leading indicator that the markets were possibly going to decline. Confirmation came from the impetus chart, of course. So these negative divergences are indicated by red arrows on your chart, as you can see. Mercifully, the price still remains above the 25-day exponential moving average, but barely so. Compared to the Bank Nifty, the distance between the price and the 25-day exponential moving average on the Nifty is very small. So any sustained trade below this threshold can actually accelerate the falls, because the bulls are likely to be in a loss on a cost plus cost of carry, which is rollover cost basis. If you have been rolling over your long positions over the last 2, 3, 4 months, every month you are paying interest costs and trading and execution expenses to roll over your position. So that actually is something that non-market participants don't take into account. But you as a trader will have to incur these costs, which you must keep in mind. And note how the dashed blue trend lines of progressively steeper angles have been plotted on the graph, and a slowing momentum is witnessing violation of these trend lines one at a time. Now this is called a bump and run reversal pattern in technical analysis, and which indicates that once a support of a higher magnitude is violated, support will be provided by a trend line which is lower along the line. Now, this lower trend line where support is possible to see in the coming week or weeks is at a very steep 14,000 mark. Now, that's a good almost 1,000 points below. I'm not saying that necessarily the markets will fall to 14,000 where the Nifty is concerned, but the possibility, even though remote, does exist. Now, take a look at the weekly chart. The last candle is a very prominent bearish candle which has overpowered the previous bullish one, and this pattern is called the bearish engulfing pattern, where the bears have hugged the bulls in the previous candle by overpowering them and captured the bulls. Now the weekly high, which was at 15,432, is something that you need to watch out for. If the bulls take the Nifty above this and keep it above this, all is well. The bulls are back in command, they are in the driver's seat, and the market can rally. But a sustained trade below the week's low at 14,898, which is closer to where the Nifty has closed rather than the intra-week high. If the bulls are unable to defend this weekly low of 14,898, then further declines are likely. In the week before last, this index was at number 8 on the most volatile list, but last week it fell to number 14. Now, this is not because the volatility has gone down, but because the decline has triggered huge amount of spike in statistical beta, which is sheer pure price volatility in individual stocks which have risen above the Nifty in volatility terms. So the challenge for traders still remains on the Nifty. It's still going to be tough. Now, last week I advocated an estimated range of 15,700 to 14,600, which held perfectly. Next week I expect estimated, I stress on the word estimated, range between 15,525 on the upside and 14,425 on the downside. Now, the Jensen's measure. Now, this is again another statistical tool which tells you whether taking on additional unit of risk is worth the effort or not, and whether the reward will be commensurate with the risk. This is the third week in a row that the Jensen's measure statistic on our trading model is hostile towards the bulls and tells me that fresh long positions, at least leverage fresh long positions, are a strict no-no. Don't try to average your futures positions if you're in a loss, because that can really set you back where mark-to-market payouts are concerned. So, I think you need to still trade on very small volumes, as I have been advocating every evening on my social media accounts, wherein I put in a lot of statistical output from our trading model. Late evening, which you can connect with me. Our contact coordinates will come at the end of this video, and we can have conversations going, discuss markets, and share our output. Now, the Nifty done, my friends, I come to the most popular segment of this video, wherein I give you 5 stocks that are suitable for highly volatile, high impetus stocks, and 5 stocks that are low impetus and favorable for intraday traders who take large exposure and wait for small price moves. So the high beta, high impetus stocks where you take small exposure, wait for bigger price moves are led by Nestle at number 1, number 2 Torrent Power, number 3 Hindustan Petroleum Corporation, number 4 Tata Consultancy Services, and number 5 Bharat Petroleum Corporation or BPCL. That means 2 oil marketing companies in this list of 5. Now the low beta, low impetus list wherein you take big exposure, wait for small price moves is led by Z Entertainment on number 1, number 2 ICICI General Insurance, number 3 SBI, number 4 Mahindra and Mahindra, and number 5 Shree Cements. Now friends, do remember that the hierarchy of this list can change day to day as volatility expands and contracts, and therefore you need to be extremely careful in your trade bet sizing. Friends, coming up on your screen are my contact coordinates. Feel free to connect with me, and we can share a lot of output, and you can basically see a lot of statistical data at the end of the day and connect with me. If you like what you saw in this video, do subscribe to my YouTube channel. Click on the bell icon to receive alerts about fresh videos being put up here. In the comment section, keep the communication lines open. Do tell me what you think of this video, and help me reach out to fellow like-minded traders with a 360-degree worldview by referring my video to your family and friends. I wish you a very, very profitable day ahead. Vijay Bhambwani signing off for now. Thank you for watching. Take care. Bye-bye.